Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading weekend in October 4th, 2024. I'm Preston Brent. Thanks for tuning in. Well, the theme this week landed on Friday. Jobs, jobs, jobs. That pretty much set the tone as we went into this weekend. I believe we would have probably finished in the red this week if it hadn't been for the jobs numbers. So why don't we just jump in and take a look at this prior week and just see how prices are stacking up around the planet. Let's start with the U.S. first. You can see just barely in the green. The Dow up just 9 basis points, S&P 22 basis points, NASDAQ 10 basis points, Russell actually down a little bit. Year to date, everybody's still having a solid time. But this is the fourth consecutive weekly gain for most of the markets, even as we're seeing growing tensions in the Middle East. Prospects of a wider war also sent oil prices to their highest level in about a month, which benefited energy shares, of course. But we did see markets kind of start off the week relatively quiet, but it picked up steam pretty quick when Iran came out and talked about retaliatory ballistic missile attack against Israel, of course, which they did later on. Then another complication earlier in the week was a walkout by the workers, port workers, on every major port in the East and Gulf Coast. But that, which is about, I remind everybody, is about half the capacity of all U.S. trade volume. But later this week, they came out and put the strike on pause until mid-January, until they can negotiate some kind of settlement. I suspect they will. But if you look at this, you can see that the PE ratio is very rich. The forward 12-month is 23.52. The prior 12 is 24.35. Either way you slice it, to me, it's a lot higher than it should be. I think we're going to see some very tired price action going forward here through the end of this year. The dividend yield, 1.28 10-year Treasury, finished just slightly under 4%. It's up for the week. I mean, we did get the ISM report. Factory gauge activity here remains steady in the U.S. at 47.2. It's been in contraction territory for quite some time. Meanwhile, the services sector reported a jump up to 54.9. That's the highest level we've seen in the services gauge in about 19 months. It did show price pressures in the services sector increasing also at a fast pace. Nonetheless, all this news seemed to be overshadowed by the jobs numbers, as I said earlier. We've seen employers adding 254,000 jobs in September. That's about twice what the consensus estimated, so that was a wide blowout. They even revised higher August gains as well. And we did see the unemployment rate tick lower to 4.1%. And one final thing, we did get average hourly earnings. They rose 40 basis points in September. And that was on the heels of an upwardly revised 50 basis points in August. So these are the fastest paces we've seen this year. But on a counter trend note, the jobs report led to a spike in longer term bond yields. They moved up as money moved out of the bond market. You know, when bonds go down, yields go higher. We saw the 10-year benchmark actually spiking to its highest intraday level since August the 8th. You can see where it finished the week at 3.96 there on the screen. The other effect of these jobs numbers is that it basically, we saw in the Fed fund futures market, the probability of a 50 basis point rate hike almost went away, or rate cut rather. Now we're looking at 25 bip cut in November and the possibility of a 25 bip cut in December. In fact, what finally showed on the screen was just a 3% chance, although it's a small one, that there may not be any cut at all in November. Now, I think the only way that's going to happen is next week we're going to get the CPI inflation data, and if it really takes off and goes back up, then I don't think you're going to see any rate cuts in November. But anyway, strong week to finish the week with the jobs numbers. It appears the economy, at least thus far, on the surface level, is okay. You can see the best performer for the week was obviously energy with the trouble in the Mideast. Worst performer, staples. Year to date, utilities still holding it in 31.38%, real estate bringing up the rear. It's still a rather robust 11.26%. If we go across the pond and look at what's going on over there, completely opposite, you can see everybody in Europe from the Euro stocks, which is the 50 largest companies across Europe, the FTSE CAC 40 DAX, all finished in the red. In fact, the CAC 40 finished is year to date flat to slightly in the red. PMIs over there reporting are pointing basically to a weaker Eurozone growth, right? We did see inflation, headline inflation over there fall down all the way down to 1.8%. Remember, the ECB target is 2. Now, the core is still in there at 2.7%. But basically, the Eurozone composite data does suggest a dramatic slowdown all across Europe. And that we're seeing is reflected in this price action this past week. Also, the governor, Andrew Bailey, he's the governor of the Bank of England. He basically indicated that they could come a bit more aggressive in lowering borrowing costs if their inflation continues to fall, like they're seeing across the Eurozone. So we're going to have to keep a close eye on that. Then, of course, if we go over to the Asian markets, Japan, the new prime minister came in, and his monetary policy views are considered a little bit more hawkish than the prior prime minister. So it initially led to the yen strengthening just a little bit, sending their markets a little bit lower. You know, they're trying to digest what his policy views are going to be. But he also said that the environment right now is really not ready for an additional interest rate hike. So that took some of the pressure off a rising yen. You know, you guys know that, and it's been one of my low-hanging fruit trades going back about 4 or 5 months being long the yen. I could just see that coming. And our members, some of our members that took that trade really did very well. So that's what's going on in Japan. Meanwhile, in China, they continue to surge. They had a holiday shortened week this past week, but optimism about all of their stimulus, their support measures are kind of offsetting still disappointing data coming out of China. Factory activity there contracted for the 5th consecutive month among weak demand. Remember, when demand in Chinese factories are lower, that means the exports are lower, which means what Europe and the US is buying is lower. So this does show a little bit of a slowdown in global demand. We got the PMIs there came in around 49.8. Now it was 49.1 in August, but still in contraction territory. But the whammer, which is what's killing China, quite frankly, is the real estate market. The value of new homes sold by the country's top 100 developers in September fell 37.7% year over year, right? In August, it fell 26.8% year over year. Still horrible. And I read an estimate in Barron's this weekend, which totally blows me away. There are an estimated 90 million empty housing units sitting in China right now. It's enough to house over 270 million people. So I guess they could take a lot of illegal immigrants in there, but I don't think anybody's going to be going over to China anytime soon. But that's what's going on over there right now, folks. So let's go over and just take a really quick look at the U.S. indexes and see how they're all shaping up. And I'll show you what I mean by just market action. Get a little bit tired here. Let's get this on the screen like this. Here we go. So it's going to take a couple of seconds to come up on your screen. But what we're going to start with, as I always like to do, is the E-mini S&P 500 futures. 70% of the market tends to follow the S&P. So you can see here where we've had higher highs and higher lows really coming off of the August 5th crash, right? That little, when they reversed the yen carry trade. You could see my target's been here for a while. And we came right up to my target, and we're having a hard time getting over it. The all-time highs were made on September 26th, up 21.14% intraday at 58.30. This is the E-mini futures. You can see I've got a pullback point calculated here between this gap up right here, which puts us, if I had to go in the middle of the gap, right around 56.50. And to me, that seems like a most likely resting point sometime over the next 2 or 3 weeks. I don't think the dip is going to come back down to this low point that we hit over here in early September. just because we've got very strong MACD. There is no bearish divergence here. You can see the 50 EMA is sitting also right in the middle of this upside gap in the SPX, which are the E-minis. You could see a big move there. So come back and fill this gap sitting right on the 50 EMA, which is around 56.34. Makes sense to me. All right, you can see both my longer and near-term dated pullback points are both in the 5600 area, 5650. So that's what I would say is a higher probability move. Okay, if we come in here and let's just kind of go around the horn and look at some of the other indexes, you could see the Russell here. Really, we haven't gone anywhere. It's typical of the Russell, really wide swing since we were moving out of the red into the green back on August, coming out of the August 5th move lower. We finally moved back up, captured the 50 EMA. You could see this little bit of a pullback here. I don't see any warning signs that would suggest it's going to go back into the red for the year. Just a lot of chop right now. I've heard a lot of people say, well, I want to go on the small cap and the Russell. You know, when they're cutting interest rates, it's going to take off. But a lot of the companies in the Russell 2000 just aren't making any money. And if you can see the talk of a recession is pretty much off the table now, but we have to be very careful in these markets, especially these small cap stocks. I'm not ready to say go all in on small cap. I think we're going to have this continued chop for a while. If we look at the FANG index, you can see here where the FANG's the last all-time high we made in the FANG index. And in this, I include Microsoft, Meta, Apple, Google, Amazon. You can see it was on July the 10th in the middle of the summer. We were up 35.71% intraday. We did regain the 50 EMA, but we haven't made new highs yet. So on this big move up off that August 5th hard move down, we've seen the technology stocks lagging and money flowing back into more cyclicals and into the 400 and other 93 companies that are floating around out there. Now, will that last? If we get a harder pullback, which is what I'm expecting, somewhere between 3 and 6%, I don't see anything much harder than that right now, unless we get a surprise, either geopolitically, militarily, or we get some kind of surprise with inflation data. And I will remind everybody that we got the November elections coming up first week of November here in the U.S. So there's always going to be some volatility in these markets until we clear these hurdles. So just anticipate that. If we come down here and look at the Dow futures, you're going to see here on the Dow futures, we're near the all-time highs, right? But we've been running sideways going all the way back to the 19th of September. Almost 2 weeks of just sideways moves. We go down, we go up, we're staying in this box right here. Now the question is, are we going to break out to the upside or the downside? The odds favor an upside breakout, but I'll remind you, we also had that gap move here in the futures market, and gaps typically get filled. And like the E-minis, and you can see here the 50 EMA is also sandwiched in the middle of this gap, just like in the E-mini S&P 500. That would make a sensible pullback point to me, although I don't see any divergences in the MACD, just like the S&P. So that suggests that any pullback, it's going to be a buy the dip moment, at least for now, unless I see some changes in the market. And then finally, we'll look at the NASDAQ 100 futures. And you can see here, like the FANG index, the last all-time high was made on July the 12th of this year. And now we're just, it's not showing the same kind of strength as we got from the E-minis, S&P, and the Dow. Okay. If we look at the equal weight now, you'll see what I'm talking about. The equal weight actually had strength. You can see the equal weight is much closer, like the Dow and the E-minis, S&P 500, to their all-time highs. The equal weight, you can see where they're sitting right now. Holding in there. So that does say there is a lot of sector rotation going on right now as we get through these last 3 months of the year. All right. So I'm kind of seeing that kind of movement there. If we come down here and look at the VIX is really quite interesting, even though the market's finished slightly higher for the week. You can see the VIX moved up for the week as well. I mean, we've been moving up on the VIX since the end of September. So October, we've seen the VIX move all the way up into almost my red zone up here. We did have an intraday high back over here on the 3rd of October, right around 2077. We pull back just a little bit, but when the VIX gets up into this upper boundary right here, the tendency is for it to see short-term spikes like we see over here. I don't think we'll clear this level here right around 24, unless we get a surprise in the markets that no one's seeing right now. Okay. And we can. Now, if we look at the bond market, you can see bonds had a hard down day on Friday. The jobs numbers did this. So why would the bond market go down on a strong jobs day? Well, keep in mind that money is tied up in bonds, but if the equity markets are moving higher, the tendency is for people to take money out of bonds and shift it into equities, from debt to equity. And when money comes out of the bond market, that generally moves interest rates higher, which is why we've seen the 10-year yield moving higher, even though the Feds are cutting rates. So that does go to show you that the bond market and the 10-year Treasury, the Treasuries pretty much control where the interest rates go, no matter what the Feds would like to tell you. All right. So you can see we're back into the red year to date in the bond market. Now, if we step it out, you can see this upward sloping trend line here. So we could see the bonds move down a little bit lower here, catch this trend line, move up, but we're going to sell the rally in the bond market for those of you that like to trade the bonds or bond futures. If we come down here and look at currencies, well, obviously the dollar loved a strong jobs market, and you can see right here, the dollar came down right down this area down here. My target was around here. I still am projecting the dollar not to go any higher than the 200 EMA before it starts to roll back over again. Okay. If I had to put a target for the dollar, I'll let my system do a quick auto gen and create it. It doesn't have enough data. You can see it's trying to print something down here, but there's not enough data to show. But typically when you get a strong Elliott wave 3 down, you get a little bit of a counter move here and then a roll back over. The fact that we took out this intermediate high right over here like this, let's just put it right over like that. You can see we've taken that out and cleared it. Does suggest there's weakness in Europe, and we're seeing the weakness in the yen and in the British pound, and that tends to strengthen the dollar because it's a dollar index. The dollar moves. The euro is about 58% of the dollar index. The yen is about 13.5%, and the pound is about 12%. So wherever they go, the dollar goes in the opposite direction. So you can see here the strength of the dollar as Europe's starting to weaken a little bit. We're getting data showing Europe's weakening a little bit and the dollar getting stronger. And all we got to do is just look at the euro currency, and you can see it backing off the highs, dramatically so. Now I got to adjust it and put new highs out here, but we're coming back down, and we're now back into the red for the euro, right? This was the border between being in the green and being the red for the euro for the year. Okay. And we've taken out the 50 EMA. Now this is, I do believe we're going to get a counter move here, but we got to be very careful. You can see the beautiful bearish divergence setup right here. This was the setup to go short back on the 27th of September. As we rounded out September, just short the euro. It's like going long the dollar, and you could have done just as well. Okay. It's probably going to stay sandwiched between the 50 and the 200, and then whichever way it breaks is the way you're going to want to play the euro. If it breaks back to the upside, you want to go long euro. If it breaks to the downside, you want to go short the euro. Okay. And of course, if we come down here and look at the yen, Japanese yen, I got everybody long a while ago, back over in this area here. Now you can see with the new prime minister in, a little bit more hawkish. You would think it's good for the yen, from the bullish standpoint, and it will be, just not right now, because he did come out with a statement and say he's not ready to raise the rates, or he would support an interest rate increase. Although the Bank of Japan is like over here with the Feds, they maintain an independence between fiscal and monetary policy, and the prime minister, he doesn't get involved in the Bank of Japan issues and vice versa. But I can see a little bit of profit taken after this big move of settling in and then another move higher. So we've made some good money in the long trade in the end, and we'll just, what I'm recommending is people just sit on the sidelines and wait until it picks up again. Okay. And then finally, if we come down and look at gold, gold's had a really good move this year. It's actually beaten just about everybody. It's beaten the S&P. You can see there is no divergence here. I'll remind everybody that Japan, China, India, especially China and India, they purchased over 1,000 metric tons of gold in 2022 and the same quantity in 2023. You'd think they got some other ulterior motives. They want to back their currencies, especially China, mostly China. India really doesn't. They just like to hold gold. So the central banks are buying a lot of gold. You could see that little bit of a dip right there suggests you want to buy it. There is no divergence in the MACD. I do believe we're going to see 3,000 in gold sometime next year. And a big part of the reason gold is going up is not because interest rates go down. Although traditionally when rates go down, gold's higher, but I could show you periods of time, 4 or 5 years at a time, when interest rates are going down, and so did gold. What I think is happening here is more the debt issue with the U.S. I think that's playing a bigger role, and you're seeing central banks going out and holding more gold rather than holding more dollars, because the higher the debt goes in the U.S., the weaker the dollar is eventually going to get. Even though near term the dollar is up because of a slowness in across Europe, European equities versus U.S. equities, but longer term dollars just the fate has already been written. I don't see politicians, Republican or Democrat, doing what they're going to need to do until the markets force them. And at that point, we're going to have a huge bear market. I'll keep you guys apprised of that, but we're going to have a very ugly bear market sometime in the next 2 to 4 years. And we'll get a good heads up on it. Right now, what we're going to get is dips, and we're buyer of the dips right now at this short term, unless things change. All right, so that's gold. If we look at copper, you can see with that big stimulus in China, it really moved copper up. Copper goes where China goes. Now it's sitting at a sideways pattern. Remember, the underlying strength of the Chinese economy is weak, which tells me that copper is probably going to start to slide back down. Some bear call spreads in the copper market to me makes sense. But that's kind of what I'm seeing here. And then, of course, if we come down and look at silver, right? Remember what I told you guys with silver a week or two ago. Silver made new highs on Friday, intraday, and then it pulled back up 38.29%. When silver was down here, I said go long silver and short gold. That would have been a home run trade. Some of our members took it that knew how to do pair trades. But it was just, the ratio of ounces of silver to ounces of gold got too far out of whack. They tend to go together, although silver does have an industrial component to it, but they generally stay in a general range. And when they get outside that range, I love to play that pair trade, bringing them back together again. And that's what I was talking to my members about over the past couple of weeks. That turned out to be a good trade for the few that took it. Anyway, that's what we got there. And then, of course, we come down and look at energy. You're going to see oil is up big time for this past week. You could see we're back in the green again. We came down and hit my target perfectly. And then we've got an ABC pattern. We're going to run sideways a little bit here unless we get a little bit more issues. If Israel goes into Iran, which I believe the likelihood is very high that they will, at least in my mind, 70, 80%, that's going to put a little bit more of a fear premium in oil. If they start taking out the refineries, you're going to see oil go back up into the high 70s, low 80s very quickly. And then these situations are really good to start looking at short in oil because it does not stay up there that long. There's too much supply and not enough demand. This is mostly a fear premium that's baked into it because of the geopolitical and the military risk of starting this thing there. So I like the situation of being able to sell oil if it can get up much higher. That'll be something we'll take a look at later on. Okay. And then, of course, if we look at nat gas, volatile as usual. Up in this area here, I'm more interested in selling nat gas than going long nat gas. My original target for nat gas, quite frankly, when we were back over here, I thought it was going to come back up, hit this level right around here, and then roll over. but it didn't. There was just a lot of use of nat gas, and now we've taken off, but it's not designed, at least with a given supply versus demand, to be up at this level this long. We are going into the winter months, but typically nat gas will peak around the November, December time frame. And then as we start coming out of it, it's going to start working its way back down again. So I'm more interested in being short nat gas, not long nat gas. All right, everybody, that's a really quick update on some of the key markets that I wanted to show you guys this weekend. Members, I'll see you tomorrow evening for our weekly market watch. If you're not a member, highly encourage you to come in and check us out. Any one of these trades I pointed out to you could have paid for the membership 3 or 4 times again and again. Have a great weekend, everybody. Ciao.